The tax-free savings account, or TFSA, is one of the best accounts for growing your investments. But are you using it as efficiently as possible, or are you making these common mistakes? Hi, my name is Kovalchuk, and I'm an Associate Portfolio Manager at Claret Asset Management. Here's why the TFSA can be a great investment vehicle if you're using it effectively. A TFSA allows you to set aside money in eligible investments and watch those savings grow tax-free throughout your lifetime. Interest, dividends, and capital gains earned in a TFSA are tax-free for life. Your TFSA savings can be withdrawn from your account at any time for any reason, and all withdrawals are tax-free. However, there are a number of mistakes you should avoid with your TFSA. The first mistake is using it as a savings account. A lot of people will simply place a chunk of money in their TFSA and then use it as a bank account. It's pretty easy to see why people do that. It's called a tax-free savings account, not a tax-free investment account. At the end of 2020, a Bank of Montreal survey found that on average, TFSAs contain 38% in cash. Now, keeping an emergency fund with enough cash to cover 3 to 6 months of expenses is a great idea. But as you start to accumulate cash, you may want to move that emergency fund out of your TFSA and into a normal savings account. Additionally, in a high inflation environment like we are in today, you do not want to hold cash outside of an emergency fund. Some say that cash is trash, but real assets and strong companies with pricing power can keep your purchasing power over the long term. The second mistake is withdrawing and contributing to your TFSA in the same year. I have to admit, this is a bit confusing. Logically, if you withdrew $5,000 from your maxed out TFSA, you could recontribute the $5,000 later in the year without making an over-contribution. However, that's not the case. Withdrawals from your account can be replaced, but you will not recover that contribution room until the following year. For example, if you were to withdraw $5,000 from your maxed out TFSA today, you would not be allowed to recontribute that $5,000 until January 1st of the next calendar year, at which point you could add $5,000 to your account plus the annual TFSA limit. The third mistake is over-contributing, which can be extremely costly. If you exceed your TFSA contribution limit, the amount that you've over-contributed is subject to a 1% per month penalty. For example, if you over-contribute $5,000, you pay a penalty of $50 every month as long as that excess sits in your TFSA. So if you hit the annual limit by August and this $5,000 over-contribution stays in your account until the end of the year, you'll pay $250 in penalties. Luckily, fixing over-contributions is a relatively easy process. First, contact your financial institution and ask them to withdraw the excess funds ASAP. If you receive an overpayment form along with your excess amount letter, send both back to the CRA as soon as possible. That's it. That being said, if you want to appeal the over-contribution for whatever reason, you must send the CRA a notice outlining the case, providing your personal information, a detailed look at the situation, steps you're taking to address it, and why there was an over-contribution in the first place. It could take a while to hear back, but if the CRA deems the overpayment to have been made in error, they may reimburse the penalty you paid. It's worth a shot if you can make the case. Mistakes do happen. The fourth and final mistake people make in their TFSA is overtrading. Warren Buffett once said, "People think that because they can trade, they should trade." However, this can be an extremely costly mistake in a TFSA. Generally, interest, dividends, or capital gains earned on investments in a TFSA are not taxable either while held in the account or when withdrawn. There are, however, circumstances under which one or more taxes could be payable with respect to a TFSA. The CRA has cracked down on alleged TFSA abuses in recent years. In 2018, the Globe and Mail reported the CRA was looking for $100 million in unpaid taxes from TFSA holders, stemming from audits conducted over 7 years. Some of the factors they considered in deciding whether a taxpayer was liable for taxes in a TFSA were frequency of transactions, period of ownership, knowledge of the market, time spent, and financing. The CRA's interpretation of tax liability would not catch a TFSA that made $1 million buying and selling securities twice in 5 years. But another equally sophisticated investor who bought and sold a security 500 times in the same period and also made $1 million would be taxable in the CRA's view. Should you, as a long-term TFSA investor, be worried about being audited? Probably not. Those who are successful at generating unusually high balances in their TFSAs might expect to hear from the CRA at some point. But most ordinary investors who hold ETFs, pooled funds, or a handful of blue chip stocks are not the CRA's definition of an abuser. Using a TFSA to shelter investments that would normally be taxed at the highest rate is always a good idea. But if you can avoid making the above 4 mistakes, your TFSA could prove invaluable over time. For more investment tips, visit our website at claret.ca or get in touch with me directly by clicking on the links in the description. And don't forget to click the subscribe button below.